Thanks for tuning into Worldview. I'm your host, Niraj Shah. Our guest today is Savita Subramanian, Head of US Equity Strategy, BofA Securities. Savita, such a pleasure talking to you right here in Mumbai.
It's great to be here. Very exciting.
How's the India trip been thus far?
It's been very interesting. I've been traveling all over the place, meeting with institutional investors, taking field trips to malls and checking out the scene in Mumbai, and it feels like activity is quite energetic here. There's lots of infrastructure, and it feels like the city is buzzing.
Okay, I'm going to come to that. I think some parts of the country are doing the same as well. But let me start off with your overall worldview, Savita. There is, over the last 9 months, at every single point of time, every single day, you can count at least 10 strategists who are calling out the winds of caution and why people should be careful. And markets seem to have climbed the wall of worry. US markets, India, some of the others as well.
Yeah.
You guys were among the first ones to call it out. It was a brave call back midway through 2023. What's your stance now and why?
Well, I'm still positive, maybe a little bit less bullish than mid last year. And that's simply because sentiment has improved a little bit from these really dire bearish levels that we were at. You know, last year, I think, after the collapse of SVB, there was just a complete capitulation in terms of, equity forecasts. And I think there was this view that we were heading into a 2008 style financial crisis. And when we looked at the equity market, when we looked at consumers, we didn't necessarily see the same balance sheet risk. But what actually made us feel really kind of confident in our outlook, in our positive outlook, was the fact that it was a very gut-wrenching call to make, because so many intelligent people disagreed with us. There was a lot of swirling anxiety around this credit cycle potentially unfolding. So I think whenever you're making a call that feels very uncomfortable, it's usually right, because you're going against the trend, you're going against this sort of, what's probably priced into the market. And today, I would say it's more comfortable to be positive. There are more people that agree with us, so that makes me a little less bullish, if that makes sense. Because ultimately, I think that sentiment is the best indicator in the near term, and sentiment right now is kind of neutral, not bearish.
So early March, you upped your targets on the S&P. I'm talking about the US markets currently only. And I hear you say right now that because so many people are in consensus, that makes you uncomfortable. You reckon that or those levels could be near-term tops unless something else develops materially?
I think where we are today is an interesting environment, because there is increasing bullishness on certain themes in the US market, like AI, like drug discovery and other aspects. But the bullishness hasn't necessarily broadened out to the overall market. So if you look at the average mutual fund manager, his or her exposure to cyclical versus defensive sectors is at almost the same levels that we saw in 2008, 2009. No bid on economically sensitive areas within the US market. And I think that is where we see the strongest potential for gains. But we do see a lot of crowding of investors, individual investors, pension funds, mutual funds, hedge funds. Everybody is kind of glommed onto this AI theme. But I think there's more to go beyond just buying the CapEx takers in the AI world.
Okay. So if the US markets hitherto has been the story of the big seven, and you could argue even within those seven, maybe four, if you will, do you think... It's
even narrower.
It's even narrower. Do you think it broadens out, though, even if the headline numbers stay kind of flatline?
I do. I think that we're actually seeing it now. And in fact, in March, I think March was an interesting transition month, because in March, I think 60% of the companies or thereabouts outperformed the S&P 500, whereas prior to March, it was well below 50%. So we're now in an environment where if I'm a stock picker and I just throw a dart at a dartboard, I have a higher chance of picking an outperformer than an underperformer. I mean, obviously there's a lot more to investing than throwing a dart, but I think that just the odds of, picking stocks that can outperform are increasingly better. So, our view is that you can move from just this these 4 mega cap companies that have been crushing earnings to a broader array of equities, some of which have been ailing recently but are starting to come out from their profits recession.
Interesting. So, Savita, here's my question. It's a year of, well, the big US election. It's a year of dichotomous views on what the Fed would do, and you talking about maybe broadening of the rally, if not the earnings. Would you believe that markets could flatline or maybe even stay at these levels, even if we do not see rate cuts for the rest of the year?
Yeah, this is the question, the trillion-dollar question today is, will we see these 3 rate cuts that the Fed is that investors are expecting the Fed to do? I think there is a real risk that we don't see 3 rate cuts. And, our economists are forecasting 3 cuts, the first coming in June, but they acknowledge that there is a, downside to this forecast. In that environment, I still think the equity market can do okay. And in particular, the S&P 500 can do quite well because a lot of these companies, I mean, think about even this Magnificent 7 or Magnificent 4, these are mega cap companies with net cash sitting on their balance sheets. So they're actually making money as short rates have moved higher. And, similar story for consumers. U.S. consumers, the lion's share of household net worth sits on retiree balance sheets. Retirees are mostly homeowners who have termed out their mortgages and are now paying a very low mortgage rate of 3% or thereabouts. And they're reaping a 5% return on their short duration asset base. So this idea that the Fed is going to raise interest rates and slow down the consumer has actually not worked as well as the Fed would have expected. And I think it's because, both corporates and consumers anticipated or essentially took advantage of this super low interest rate environment, locked in fixed rate, low obligation debt, and are now enjoying the higher asset yield on their cash and short duration bonds. So it's a really unusual environment where actually hiking interest rates at the short end hasn't necessarily done all of the things that the Fed would have expected. I think the real risk to the economy and to the U.S. consumer actually meaningfully slowing down is broad spread job losses. And we haven't yet seen that. So we've seen some job losses, layoffs in Silicon Valley and Wall Street, but not necessarily across middle America. And in fact, it's really hard to source labor in manufacturing across the, the middle of the U.S. There's a lot of reshoring that's taking place, and it's driving manufacturing. And what we're hearing from small business owners across the U.S. is that it's really hard to find labor, and you have to pay up for labor in these areas. So I think the idea that U.S. consumers are going to stop spending because rates have moved from 0 to 5% is not necessarily the math we should be paying attention to. Instead, we should be looking for real wages. Are real wages positive or negative? If they're positive, I think consumers can continue to spend. The U.S. consumer has an insatiable appetite, and they will generally surprise in terms of spending more than we all forecast.
Yeah, I think the rest of the world, say for China, is hoping that now the rest of the world gets a slice of that U.S. consumer, right? You think that could happen? Just a broad macro view of sorts that there is this whole China plus one in cases Europe plus one theory playing out from manufacturing. Could it happen from a consumption or direct B2C businesses, if you will, as well, that China stops being the most favored or the most sought for supplier for the US consumer, and other economies pick up the mantle?
I think that there is a theme taking place. I mean, even India, I think when you look at consumption trends, it's really exciting to see sizable changes that would probably be surprising to your average US investor. So, for example, iPhone sales were very high here. I think we hit records in terms of regional sales of Apple. And that's not something that you would have expected to see in the India consumer, where I think there is this view that the India consumer is more value-oriented, but higher price point goods are flying off the shelves here. And, I think that speaks to, potentially an income divide that's increasing in many regions of the world. Like in the US, there is this, massive divide between the haves and the have-nots, which is starting to close. So actually in the US, counter to what's happening here in India, the layoffs are happening in higher income, white-collar jobs. So we're seeing a trade down of consumers where, Walmart has cited that their sales are growing the fastest in consumers that are making over 100,000. So these customers are trading down into lower price point retailers, and I think that's one of the interesting areas that could maybe put some pressure on luxury goods. But then when you look at what's happening here, it's a very different story. There's actually a growing demand for luxury. So I think that it's important to keep this global view, and I'm happy that I was able to see it firsthand. In some sense, India has never had this cycle of luxury doing really well. It's the first time in so many years that we're seeing premiumization take so much center stage, if you will. This is a new theme. I think this is a very new theme, and it's surprising. Yeah, I think that it's something that we should pay attention to. And I know, 10 years ago, we were always trying to find companies with the potential to grow their China exports, their China consumer exports. Today, maybe the new growth theme is looking for companies that can grow their India exports, because this is a huge population base, and there's a potential for increasing demand here. So sorry, just before we take that break, you were saying that there might be a chance for companies globally, or stock pickers globally, or strategists globally, to look at companies which might enhance their share of exports to India. Exactly, yeah. So I think that there's this idea that, today the percentage of sales exposure that the S&P 500 has to India is de minimis. But, 20 years ago, China's sales exposure was de minimis, and that grew to be at least 10% of a lot of these consumer companies and multinationals. So I think the idea that we're going to see that grow is, one of the themes that we're paying attention to. As strategists, we're always looking for growth themes, and I think this is sort of an interesting one to track. Obviously, there are, risks and trade-offs, but I think that it's a new theme that is worth keeping on one's radar. You've spoken about the possibility of a broadening U.S. markets, maybe not even 3 rate cuts. There is also this political calendar-filled year, India, U.S., etc. Everywhere. Everywhere. And 2 geopolitical wars continuing as we speak. Yes. Is there a case for equity markets to do an encore or a near encore of what we saw in 2023, or is that a far cry? You mean a strong rally? Yes. Or yeah. I think there's definitely a possibility for that. I mean, when you think about it, the markets have absorbed a lot of bad news. A lot of bad news is behind us. We're currently in this sort of fairly high conflict environment. Geopolitical risk has increased, and we're in the middle of 2 wars. 2 years ago, nobody was expecting a war. So 2 years ago, there was no kind of risk priced into markets around geopolitics. Furthermore, we're at a point where the Fed has already moved the U.S. economy off of that 0 interest rate base, which was a very unnerving environment because, when you looked at a lot of these companies, they were generating earnings by borrowing money at, super low interest rates to buy back their shares. That's pretty low quality earnings per share growth. And the idea was that's not a sustainable source of growth. So what next? I think now where we are is an environment where, again, the market has absorbed a lot of bad news. Companies have been spending on efficiency gains. So over the last 2 years, we've seen companies in the industrial automation sectors reap CapEx and, kind of mint money from labor-intensive companies that are trying to automate their more expensive workforce. And what we're seeing today is finally a little bit of a pickup in productivity, which is a theme that we haven't seen in the U.S. for a very long time. In fact, since 2001 was the point at which China joined the WTO. And since then, a lot more of the margin expansion and growth in S&P companies has been driven by globalization. If things are too expensive in the US, you don't need to get efficient, you can move them to cheaper parts of the world. Now we're in a more protectionist environment, and I think what's good about that, I mean, it's not necessarily great in terms of inflation, it's probably inflationary, but what's good about that setup is that companies are forced to create tangible, visible, efficiency-driven growth, which is easier to predict than just moving stuff outside of the US.
Okay, so in that light, what do you hear about emerging markets like India? It's still, I mean, it's still classified as one, though, even though the third largest, the fourth largest market cap.
I know, exactly.
Yeah, so what do you hear about this? Because the problem is I hear a lot of people talk about how India is expensive, but then India has always been so. So what is your view, if you have one, or the BOFA view? And what is the client's view?
Yeah. No, I think that, that there is a, kind of a tendency to want to look for better growth stories than the US, because the US is a developed market. I mean, sure, it's got a lot of growth when it comes to themes like AI, et cetera, but our consumer has already expanded. I mean, there's not a huge growth story left for the US consumer. We're already consuming probably as much as we possibly can. But I think that that's the idea for, other emerging economies. China it's harder to invest in today, given, a lot of the geopolitical risks, the tech wars. So I think that India fills this void of positive demographic trends, an emerging middle class consumer, a more affluent, an appetite for more affluent, higher price point retail. So I think that that's a growth theme that's very important. And then when I talk to our India equity strategist Niraj Shah, his view is that this infrastructure that we're seeing in India has a very long tail in terms of growth. It's a 10-year growth cycle, not just a 1 or 2 year growth cycle. So there are a lot of aspects in the India economy that could turn this region into the next kind of great emerging consumer. The U.S. focus on India could really be enhanced relative to prior cycles where the U.S. was more focused on Latin America or China. I think this is a new angle that hasn't necessarily been fully vetted or tracked. So this is definitely on our radars as we move forward.
I loved one of the notes that you've written wherein that it spoke about two secular bull cases: efficiency and India. And of course, one of the things was the new aspirational consumer that you spoke about. So it's effectively that.
Yes, exactly. And efficiency is a new theme because, like I said, U.S. companies had gotten lazy about, really trying to think about how to do more with less people. And labor efficiency gains really stalled out over the last 20 years. If those are starting to become, front and center for corporate management, I think that's actually a very bullish theme in terms of becoming more labor light. I suppose the risk is if all these, U.S. workers are losing their jobs, does that hit consumption? But I think, when you look at prior cycles of efficiency gains, like in the 80s and 90s, we saw this PC cycle where, personal computers and automation was one of the sources of real strong efficiency gains. And during that period of time, you actually saw consumption increase. New jobs were created where other jobs were, obliterated. So I think that's the idea is in any tech revolution, even AI, I think we'll see new jobs created as other jobs go away.
Okay, I have two more questions.
Yes.
One, I don't know if you have an answer for this, but if 2016 showed us that it's not necessary that a November event could be disruptive for markets. It's a much spoken about US elections. India elections seem to be a foregone conclusion. Can an electoral outcome upend the US markets and thereby the world markets, because US still continues to be the mother market?
It's interesting. When you look at presidential election years, typically what you see is that volatility starts to increase, as we move into campaign season. So from July to November of an election year, a presidential election year, the VIX has increased. The VIX, which is a measure of volatility of U.S. equities, has increased by about 25%, which is usually negative for markets. But then come election day, regardless of the outcome, there is usually a year-end rally just based on the removal of that uncertainty overhang. So I think that this could be a year like any other. And what makes me feel good about the election, it's hard to know what issues are going to be front and center. I mean, we're just moving into campaign season. But I think that where we are now is an environment where both sides of the aisle agree on two very important issues. One is keep tech and IP in the U.S., and this is sort of the tech and security war. And the second is move manufacturing back to the U.S. So one of the reasons that the labor market is so tight is that a lot of these multinational companies have realized the risks around global supply chains and have actually started, meaningfully reshoring their companies back in the U.S. or in Mexico or Canada. In fact, half of the import activity that used to take place with China has moved to Mexico and Canada. So there's this very busy North America corridor, which is actually quite positive for the economy.
Okay. And I have one final question, and which is on what could happen to multiples over the course of the rest of the decade, and could that have a big impact on markets? Because we'll be higher for longer for sure, right? So we no longer very likely going to be in the zero-rate scenario of the past decade. Does it meaningfully impact what investors should expect out of equities by and large?
PE multiple, or yeah, I mean, it's a great question, and historically there has been a trade-off between, the higher inflation is, the lower the multiple, and vice versa. Today, though, I think that comparing the market multiple to prior iterations doesn't make that much sense. I mean, I don't know if it ever made sense, because the S&P 500 itself has changed so dramatically from the 1980s. In 1980, 70% of the S&P 500 was manufacturing, asset-intensive, CapEx spenders. Today, 50% of the S&P 500 is tech and healthcare. These are R&D, innovation-driven stories. So I think that just that sort of comparing today to 20 years ago is an apples to oranges comparison. I do think that, if you look at even some of these expensive tech companies, they've gotten cheaper. So earnings have actually materialized for the Magnificent Seven in many cases. In other cases, not so much. But I think that the idea that, growth stocks can grow into these multiples, I thought it was very interesting to see that Meta initiated a dividend at the beginning of this year. So it's basically a sign that this is a company that has been considered a go-go growth stock. Yeah. They initiated a dividend, and you would think that the company would suffer that ex-growth penalty, but the stock actually rallied. So I think we're in a different environment where, large cap companies can be growth and value, or growth and income opportunities at the same time. And earnings are actually materializing for many of the more expensive areas.
So good talking to you. Thank you so much for taking the time out and being in our studio, Savita. It was a real pleasure.
Oh, it was a real pleasure for me too. Thanks for having me.
The pleasure was entirely ours, and viewers, thanks for tuning into this edition of The Worldview.